You're listening to Capital Topics, episode number 88. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Captial. In this episode, we will review the ETF landscape for 2025 and what it has taught us about innovation, noise, and the need to stay disciplined. Enjoy! Good morning, James. How are you today?
François, I'm really good. As you know, I'm just back from a 3-week vacation in England and Scotland.
That must have been nice.
It was fabulous.
All right. So nice to have you back.
Thank you.
Okay, so today in this podcast, we'll be diving into the ETF landscape after what was arguably a wild year for ETF launches, both in the US and in Canada. In 2025, more ETFs were launched than ever before, especially more active ETFs than plain vanilla index-based ETF. And frankly, I believe that a lot of those products don't look like they were built with the investor in mind, at least not those with a long-term investor mindset. So today we'll ask a simple question. Is all this innovation actually helping investors?
Well, François, that's a really good question. And as our regular listeners would suspect, our short answer is no, not for the long-term investor. So most of these exotic ETFs are designed to capture the flavor of the moment investment trends, just to gather assets in order to generate fees for the product manufacturer. But more importantly for us, because we use broad market ETFs, it's important for us to look at these new ETFs insofar as how could they potentially impact markets over the medium and long term.
Mm-hmm. The key issue for the long-term investor is that the flood of new ETF is making it increasingly difficult for them and advisors to distinguish meaningful investment tools from the growing pile of distraction. So today we're going to dive into why the ETF universe is exploding with new products and what it means for building disciplined portfolios.
Okay, François, for our listeners today, we'll try to stay very high level on the topic because some of these new ETFs are quite complex to explain and difficult to understand. We could waste a whole podcast talking about one new ETF. And so we will look at the big picture level and what investors should take away from all this.
So, James, let's start with the headline. 2025 was a record-breaking year for ETF launches both in the US and in Canada. In the US, we saw over 1,150 new ETFs being launched. That's more ETFs being launched in a single year than what existed in total 20 years ago. And out of all these ETF launches, close to 65% of them were actively managed ETF. There are now more actively managed ETFs in the US than there are index tracking ETFs.
Well, this is a really significant fact that you share with our listeners, François, because most investors really equate an ETF with index investing. And I must add that for the first time ever, there are now more ETFs available than individual stocks listed in the US market. In a recent ETF research report by the National Bank, there's a chart that shows that there are close to 5,000 ETFs trading in the US currently.
Yeah, that's wild, James. And it's also true here in Canada. There are now close to 1,800 ETFs in Canada. Well, imagine explaining that to someone in 2005 that the industry would reach that threshold. I think they think we're crazy.
Absolutely, François. So we at PWL, have been investing in ETFs for over 20 years. At that time, PWL was actually recognized in the industry as the ETF guys because we were early adopters of an all ETF portfolio. And I remember back then there was just a handful of ETFs available for us to build robust portfolios.
Yeah, that's true. And now in terms of ETF launches here in Canada, we're now not far behind the US, given the size of our market. there were 364 ETFs launched last year. And again, like in the US, the majority of them, 239 to be precise, or almost 2/3, are actively managed. And that does not include inverse, leverage ETF, crypto asset ETF, and other sector ETF. All these ETF fall into the passive bucket, but we believe are tools used mostly by retail investors to trade them actively.
Exactly right, Francois. I mean, it's a huge shift from the past. For years, ETFs were basically synonymous with low-cost index investing. When essentially you bought an ETF because you wanted broad market exposure, low fees, tax efficiency, and transparency. Now the ETF product structure is being used for all kinds of other strategies. Like you mentioned, Francois, active strategies, derivatives, leverage, single-themed investing. Investors really have to be careful in this environment that they understand the underlying assets in the ETF basket and the risk of investing in them.
That's it, James, and that's where the concern starts. The ETF wrapper is neutral, it's just a tool, a delivery mechanism, but it's what's inside that really mattered, and that's what is increasingly questionable.
I would add, François, that our colleague Ben Felix, in one of his recent YouTube videos, calls this tsunami of new products the ETF slop. The point's making is that most of these new products are very low quality and produce in mass quantities, similar to artificial intelligence generated products, which is where the slop kind of originated.
Mm-hmm. Exactly. A lot of these products are designed with marketing in mind to gather assets and generate revenue, and not with investors' long-term benefit at the forefront. According to a National Bank Capital Markets report, the average management expense ratio, MER, for an ETF in Canada has now surpassed 65 basis points. This is far from the traditional broad-based index ETF that generally charges less than 10 basis points for Canadian or US equities and slightly more for international and emerging market equities. Luckily, however, this is a simple average of all ETF. The asset-weighted average MER is half of that at close to 32 basis points, which shows that the bulk of the assets are still in lower cost ETFs.
Well, that's really useful information, Francois, for our listeners. But there are some ETFs now with MERs above 1%. To me, that's mutual fund pricing dressed up in an ETF wrapper. The danger here is that investors see ETF and assume it's low cost.
Well, yes, it's just like walking into a grocery store in the cereal aisle and believing that because they're called cereal that they're all good for you, but none of them are healthier than your basic oatmeal.
Well, I just happen to love oatmeal, especially for colder months of the year. So I get that analogy here. Our regular listeners know our belief is in broad-based, low-cost index ETFs for, the best long-term investment results. It may be really boring, but they are now competing for investors' attention with all the noise in the markets today.
Exactly, James. And we have reached a certain point when the ETF innovation is starting to look like a brainstorming session gone off the rails. And this is no joke. I read this in a Jason Zweig article from the Wall Street Journal that there is now an ETF based on UFO disclosure. The fact sheet says, and I quote, "The Total Captial UFO Disclosure ETF is designed to invest in companies positioned to benefit from government disclosures, confirmation, or exploitation of advanced technologies tied to unidentified anomalous phenomena."
That's just the height of silliness, François. I mean, who would ever have thought it? An ETF based on UFO disclosure, and the firm behind it is Total Capital. Tuttle itself is kind of a funny name, so I don't know. It's just bizarre. But really, the point is this is where financial engineering meets entertainment. And while it's amusing, it should also be a concern to investors because these products are not serious investment tools, in my opinion, are clearly being marketed to retail investors who may not understand all the risks that they're getting into.
Yeah, correct, James. And in addition to the investment risk, because these funds are tiny and niche products, they often gather only a few $1 million and they eventually shut down. In 2025, according to Morningstar, around 150 active ETF closed or merged in the US alone. I don't have the data for 2025 here in Canada, but in the last 2 decades, a recent article from Globe and Mail stated that 654 ETFs have closed or merged here in Canada.
That's incredible. Again, if you're an investor in those funds, that's not a pleasant experience when they close. So that's the other story. There's record launches, but it also leads ultimately to record closures. If a fund doesn't gather enough assets, as you said, François, the manufacturer is just going to close it down. And that's a really nasty experience for investors. They are left with consequences that are out of their control. These include the timing of the windup and the tax consequences of the liquidation.
Yeah. And it's not just all small firms that are closing funds. Even big names like Fidelity and ARC in the US, or BMO, RBC, and McKinsey here in Canada have shut down ETFs last year. If the assets under management aren't there, the products disappear. So investor must understand that the excitement doesn't equal long-term value. And unfortunately, those who don't understand eventually figure it out at their own expense.
Well, totally, François. Investors must understand that new product manufacturers must compete with global giants like Vanguard, BlackRock, and State Street. So if you're a new ETF product manufacturer, you're not going to launch another Standard & Poor's 500 fund because you can't compete with these large players on scale and therefore have as low fees as them. So the business logic is that they go where the margins are going to be better, right? Mm-hmm. So that means single investment themes that reflect current trends, complicated derivatives and options overlays, and single stock strategies. In fact, anything that looks innovative and may grab attention and therefore assets.
Yeah, I agree, James. And let's remember, the investment industry is not your friend. They're out there to make money, and that's why we are seeing this explosion of niche, complex, and high-fee ETFs.
So, and I think it's fair to say, François, that the industry plays directly on investor psychology with themes that tap into optimism and the belief that recent trends will continue. Fear of missing out kind of stuff. So, for example, we've got covered call ETFs that tap into investors' desire for safety of income. Another example is buffer ETFs that tap into investors' loss aversion bias. Some other examples, inverse or leverage single stock ETFs and crypto ETFs. And they're all built for pure speculation. And by that, I mean investors are making short-term bets on, market direction.
Absolutely, James. And the ETF wrapper makes everything look clean and accessible. It's like putting a complicated machine inside a nice little simple box.
Exactly. And that's why investors need to be really extra vigilant. The wrapper is easy to understand, but the strategy inside it or the underlying assets may not be.
Yes, and the marketing is powerful. The industry uses words like income, buffer, defined outcome, yield, AI, innovation, and those keywords all trigger emotional responses.
Indeed, they do, François. But again, it's all marketing fluff. But the boring stuff like broad diversification, low fees, long-term discipline doesn't get the same marketing budget.
And there's the irony, James. While the ETF universe is getting noisier, the evidence for broad-based, low-cost indexing keeps getting stronger. Both the Morningstar 2025 Active versus Passive Barometer and the Standard & Poor's 2025 SPIVA report drive this message home.
Indeed, François, in 2025, according to Morningstar, only 38% of all active funds available in the U.S. survived and outperformed their average passive peer. It's important to note here that Morningstar, in their study, does not compare against benchmarks, but against actual other passive funds in which investors can actually invest.
Yeah, that's an important distinction you make, James. The result for U.S. equity active funds managers were right in line with that number as well at 37% success rate.
So let's look at international managers, and they did slightly better than their U.S. equity manager counterparts with a success rate of 48%. So it's about equivalent to flip a coin, but that data really shows that it's driven in large part by the emerging market managers who posted a 64% rate.
Yeah. If we look at the fixed income now, active bond manager success rate fell to 40%, down sharply from the year before. And in the corporate bonds, only 4% of active managers beat their passive benchmarks last year.
Well, that's a very poor result, François. But then again, it's the long-term numbers that tell the real story. When you look at the 10-year data through 2025, overall in the U.S., only 21% of active funds survived and outperformed their passive peers. When you drill down into the U.S. large cap equity data, well, the results are worse. The long-term success rate was just 8.1%. And this is significant because this segment is where most investors in the U.S. put their money. So think these active managers missed out on the Magnificent Seven. So that's more than 9 out of 10 portfolio managers who are unable to beat their passive peers over 10 years. Over 20 years, the success rate falls to a mere 6.4%. I mean, that's dreadful.
Mm-hmm. That's very awful results. And the distribution of outcome matters. Morningstar shows that in U.S. large cap categories, the penalty for picking the wrong active manager is much larger than the reward for picking a winner. The excess return distribution is negatively skewed.
Well, François, this only reinforces the point that even if there are some active winners, the odds are low and the downside of choosing poorly is significant. I mean, what are the odds you're going to pick the managers that are winners, right?
Totally. And again, fees matter. Over the past decade, 31% of the cheapest active funds beat their passive peers compared to 17% for the most expensive ones. So that's a reminder that costs are important.
Well, if we look at active funds in Canada, the results based on the 2025 SPIVA Canada scorecard are not much different. The report highlights that 85.4% of active funds across all categories underperformed their benchmarks last year.
Yes, and active fund benchmark to large cap indices like the S&P TSX Composite here in Canada, the S&P 500 in the US, and the S&P Europe Asia Pacific all failed miserably in 2025. Since their underperformance rates were all above 89%. Over 10 years, their underperformance rates are even worse, if not atrocious, with underperformance rates all exceeding 97%. So that means that only 3% of active fund managers beat their benchmark over 10 years.
So, François, let's wrap this all up for our listeners and do a summary. What should they take away from the 2025 new product ETF Mania?
Well, first, James, don't confuse innovation with improvement. Just because a product is new doesn't mean it's better. Second, simplicity still wins. Complexity tends to increase cost, increase risks, and decrease transparency. Third, stick to evidence. The SPIVA, the Morningstar, and decades of academic research all point in the same direction. Active management does not work, especially in the long term. Fourth, investors need to filter the noise. The ETF universe is now a giant supermarket, but with lots of junk food. To eat healthy, you need to choose wisely. And finally, James, let's remember the words of John Bogle, the founder of Vanguard, and I quote, "You get what you don't pay for."
That's a great quote, François. It's really timeless. And I would like to conclude for our listeners, as always, our goal is to help investors focus on what actually matters. The ETF universe may be getting more chaotic, but the core principles of sound investing remain the same. Low fees, broad diversification, and long-term discipline will pay off for those who really adopt a long-term investing mindset.
Totally, James. So thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 88 of Capital Topics. Don't forget, if you'd like to submit question or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your asset, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publication. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in. Please join us for our next episode to be released on July 22nd. In the meantime, make sure to consult the Capital Topics website for our latest blog post. See you soon.